Real estate family, you did it again. You clicked on another episode of Sold by Storm. And on today's episode, we're going to talk about key terms that it would do you well to have an understanding of. Are you ready? Let's go. All right, guys. So welcome to Sold by Storm. I'm your personal broker, Michael K. Storm with Storm Real Estate Group, LLC, powered by NorthGroup Real Estate. So on today's show, we're going to talk about key terms that you need to understand during the home buying process. And why is it important for you to understand them? Because if you're like me, the first time when I was looking at buying my first home, a lot of the information was like French. I didn't understand half of what they were talking about. What do you mean due diligence, equity? What are you talking about? Mortgage? What's exactly? I know what that is, but really what is it? What is an appraisal? Because the bank's going to require one when you buy a home. So we're going to pull up this information now that's going to go through some of the keys of what you need to understand, some key terms to know when buying a home anytime. These are going to be some of your core keys. So key terms to know when buying a home. First, I just talked about it, and of course it's first on the list. Appraisal, a report highlighting the estimated value of the property completed by a qualified third party. Lenders rely on appraisals to validate a home's value and ensure they're not lending more than the home is worth. So what does that mean? It really means that no matter how much you decide and your realtor decides to offer for a home, at the end of the day, the bank wants to make sure that the home is worth what you're offering to pay for it. And that's going to be determined by a third party appraiser. And that appraiser does not technically work for anyone involved. Even though you're paying for the appraisal, they don't work for you. They work for the good of the value of that property. So they're trying to give you the close enough value so the bank knows that is a good fit with what you're offering on the house. And if you have a great real estate broker, then hopefully you're going to offer less than the value. And that's called having built-in equity when you buy a house. And that's, hey, you paid $200,000, but the house is actually worth $220,000. You've got $20,000 of equity in your house. And that's like money in the bank. All right. Closing costs, the fees required to complete the real estate transaction, and they are paid at closing. Closing is that day that you see on social media where everybody is holding up the signs saying, we said yes to the address, and they're talking about, yay, we bought a home. They bought probably what is considered the biggest asset of most people's lives. And during that time, there were closing costs. These are the fees required to complete the real estate transaction, paid at closing. Ask your lender for a complete list of closing costs items, including points, taxes, title insurance, and more. All right. So make sure that, like I said in the other broadcast, the devil is indeed in the details. Make sure you're looking at the details of every mortgage loan that you're thinking about going forward in. Credit score, a number ranging from 300 to 850. That's based on an analysis of your credit history. This helps lenders determine the likelihood you'll repay future debts. So right now, if you've got a credit score of 300, that's going to be a pretty big challenge for you to purchase a home right now. You're going to want to get that credit score up to at least 550 for most lenders to consider you for a mortgage. But if you have a credit score of 850, and this is your credit score average. So there's 3 different credit score companies that you can get your credit report from. And so it's going to be the average of those put together. And if that score is where the lender likes it, then you'll get a mortgage. If not, you may have a little bit more work to do. Down payment. What is a down payment? Down payments are typically 3.5 to 20%. Now, 3.5, that is what you put down for an FHA loan. So if you're thinking about FHA, that would be a 3.5%. 20% down is if you are really prepared, or maybe you just sold a home and you have some cash You can put 20% down. That's going to remove your PMI insurance, and that could save you a couple $100 a month on your mortgage. Some is 0% down programs are also available. So right now, I personally work with a lender who has 100% financing. That means you have nothing to put down. They're actually going to organize your loan so that you don't have to come up with any big amount to move into your home. So ask your lender for more information about that and what you could qualify for. Mortgage rate, the interest rate you pay to borrow money when buying a home. And that mortgage rate has been in the news a lot lately. We had those terrific interest rates of 2.5% just in the last year or two, but now we're right around that 6.5% mortgage rate. So it does differ lender to lender, but mortgage rate is how much am I going to pay for the money they're going to give me for this house. All right. Pre-approval letter, a letter from a lender that shows what they're willing to lend you for your home loan. What is a pre-approval letter? It is a budget. It tells you, hey, Mr. Customer, you are able to purchase a home of $350,000. We're going to require $5,000 down, and it's going to be a conventional loan, an FHA loan, a USDA loan, or a VA loan. So that pre-approval letter is going to give you all that information. But the thing to remember about a pre-approval letter, it's not sometimes worth the paper that it's written on, because every lender is not going to do their due diligence and really dig in there and reveal everything from the beginning about what that loan's going to cost and what it's going to cost to originate that loan. So make sure that you're having a real conversation, not just putting your information online and dancing through the house. I got pre-approved for $400,000, and then come to find out that it's really not what it appears, okay? So inspection contingency. It is a provision in a contract requiring an inspection to be completed. So the essential step gives you information on the home's condition and potential repairs. So in North Carolina, we don't really necessarily have to have an inspection contingency, but we just have the ability within our due diligence period to have an inspection. So you'll have a couple weeks built into your offer that you'll be able to get a licensed inspector to come and check out your house. But in some areas, they do put in an inspection contingency, and that's just basically saying, hey, we have the right to get the house inspected before we buy it. Affordability, a measure of whether someone earns enough to qualify for a loan on a typical home based on the most recent price, income, and mortgage rate data. When home prices and mortgage rates are higher, it can impact affordability. And that gets into what is called debt to income ratio. So if you have more debt than you have income, then your debt is going to be high, your income ratio is going to be low. So you want to get to the place where your income is higher than your debt ratio so that it can off balance a little better and look better for the lender who's going to be giving you all this money. You want to know why they ask you all these questions? Because they're giving you a lot of money. So they want to make sure they're getting a solid buyer. Equity. I love equity. Equity is the value of your home above the total amount of the liens against your home. Many homeowners are realizing they have more equity than they thought, and they're using it to move. So come on back over to me and let's talk a little bit more. As a homeowner, equity is money in your bank. It is basically means that your home is valued higher than what you purchased it for. And what you can do is, if you have enough equity, you can get a line of credit from your local bank, your credit union, and it's called an equity line of credit. And basically, is usually at least once or twice a year, I send them a full report showing them that, hey, since you purchased your home and you made that great investment into yourself, now you have X amount of equity in your home. And man, that makes you feel good when you get that report and you're like, okay, my bank account, my virtual bank account that is in my home just went up 10, 20, 30, $40,000. It makes you feel good because when you have financial options, that's really what it does. It gives you freedom to have options. Let me tell you guys, when I lived in my little 1-bedroom studio over in Burlington, North Carolina, when I first met my wife, I didn't have a lot of options. Matter of fact, my landlord, his option was try to find Michael before he spends his money, because I didn't have a lot of options. When my check came, it already had places to go, already had things to do, and I was probably already trying to catch up from last month's bills in this month. And if you've ever been there, which a lot of us are feeling that pinch, especially with the inflation that's going on right now in the market, options are good. And that's what this series is all about. All the series that I'm doing right now for first-time home buyers, educating you on the terms that you need to know, educating you if it's time to buy or maybe you should wait. Everything we're discussing in this series is all about options, letting you have options. So thank you so much for tuning in today. Make sure you like and subscribe to this channel. We appreciate you guys. We're brand new here on YouTube. So make sure that you like us, subscribe, so that bell will go off and notify you when it is time for another Sold by Storm. Until the next time, Storm is passing over. I'm out.